Hey, Britton Brown here with TradeHive. Just want to do a recap here. We just got the numbers for last week's Commitment to Traders report. Came out for week ending 3/17. There's a few things that we have to talk about real quick to help you get a bias coming into next week when it comes to the COT. First, it was rollover. So we had a lot of different things that we normally don't see on the normalized participation. So up on this top part of this box, you're going to see normalized participation going up to 0.98. With rollover and the amount of spreads that are going on at this point in the game, when this happens, and obviously this happens every few months, we kind of throw the normalized participation out the window. However, net position flow was, believe it or not, coming into it, there wasn't a lot of new position uh, from the hedge funds, from the commercial side of things, from the asset managers. It was just merely positioning. Now, I will say there were some added hedges that were put on. Some were taken off, and more aggressive nature to the downside we could see in the Commitment to Traders report. However, let's talk about the real meat and potatoes here, because this is what's really important. When we have a situation where we have rollover, again, I throw out the normalized participation. I do look at net position flow, and as it stacks up, there was a decrease coming in, but that's, like I said, that's normal. But big money pressure in the TradeHive Risk Regime Index are the keys here. And what's so interesting, and I mentioned this last week, and that is anytime we're above zero, we'll call it delta neutral. When we're in a positive delta, we are in a bullish atmosphere. And we can see on the big money pressure the decrease on this particular area of the chart. We went down to 0.65, and that's really important, because what we're doing is we've been hovering above that 0.10, 0.15 area, and that's telling us, hey, the money's coming in. We can still rely on a bullish scenario, buy pullbacks. And as I mentioned last week, the regime flipped. And that's important to understand, because then we went into, hey, let's sell rallies until proven otherwise. And that clearly worked out, right? So we had a huge down day. The market got flipped upside down on some late position covering on Friday. It'll be interesting to see what happens Monday, but I will remain focused to the downside and look for opportunities to sell any kind of rallies. Again, until proven otherwise. If you look at the daily chart, you have this beautiful bearish trend line coming down, and we're in this wedge pattern. Well, we went down to 24,000, broke through that. That is a clean liquidity sweep to the downside. So with that said, the trade regime index is kind of the key. We have seen we're all the way back to the January 13th levels. And when you see that, we can see how we arced up. And this is following, if you look at the market, we had a nice run up, we flattened out, and then we started coming off. And so this is kind of mirroring what we see. So again, we're right back to where we were at the beginning of the year. My biggest concern right now is we keep dropping in the big money pressure with the hedges, those hedgers out there getting aggressive to the short side, with the asset managers rolling some of those contracts over, with the traders themselves, the big institutional traders, aggressively positioning. That was last week for this move down. That is right in line with the statement that I've said for years, and that is if you understand the institutional framework and how the institutions are playing, they're not playing for 100 points. They're playing for 800 to 1,000. That's their swing points, right? So we've hit that. We've clearly hit that. And now what I'm expecting is there's going to be a little bit of, they'll start taking on a little bit of the contracts. What I'm hoping is we'll go back down, test the lows. You'll see a more of accumulation down there from those big traders, and then we will start making our way up. And we're just going to trade this massive range that we've been in. So the problem is the expansion of the range is getting bigger and bigger to the downside. So again, it's almost a reset. But when you look at the big money pressure, if we start getting under zero delta, right, delta neutral, we flip it and the big money pressure begins to really press on the low side. So for the bears, what does that mean? If you go back just a big picture aspect of this. If you go back to 2024, 2023, where were we? That's kind of how I'm looking at it in context of the big picture, right? We are considerably higher. We do have quite a bit of fluff here that we could take out of this market. But like any kind of sell-off, right? When it's at its bearish standpoint, at that point, you should be a buyer. Just like when you're at your most extreme bullishness, you should be a seller. So any kind of big move like that, that's usually short-lived. You can go back and look at any kind of big sell-off, 10, 15%. It does it, it gets the job done, and then immediately comes right back. So, what I'd like to hear is from what's going on geopolitically. That gets a little bit stronger. By the way, I've got some great reports out there from the geopolitical side of things giving you the big picture for this. But hopefully this is very helpful here. Again, you can see on net position flow, the stack flipped on March 3rd, March 10th. It's backing off. But again, big money pressure is not great for us here. And we can see the TradeHive Risk Regime Index went right back into that zone. So I'm anticipating more of a flattening out for a week or two. We'll reset and then maybe perhaps get back into the bullish mindset once we get through the geopolitical issues that we're dealing with. Hope that helps. Go check out the website. There is a massive amount of free information. Again, this is for those people that want to go from retail to an institutional mindset and start following the big money. That's where the whales are where you want to be. You don't want this retail mindset. You know that 96% of you are going to be on the losing side of this if you continue down that path. And that's what I'm trying to do, is help you. I do that for free. So appreciate your time. Hope that helps. We'll look for next week to be kind of more of a catalyst as to the direction that we're going to take for the rest of this the month of March and into April. And just so you know, just a quick heads up, April is traditionally tax selling. So this kind of bodes well with the cycles that we see in the marketplace to dip down, find some stability, some support, and then get back into this move where we can go to the upside. Thank you very much.